Hello, and welcome to the TBR webcast, The State of the Cloud Vendor Market and 3 Key Trends to Align Your Business. My name is Allan Crawford, a Senior Analyst here at TBR, and I will be your host and moderator for today's session. Before I turn the discussion over to Stuart Williams, Director of the Software Practice, and Allan Krans, Senior Analyst, Cloud Computing, I have a few minor housekeeping items I'd like to take care of. First, I want to ensure that this is an interactive session, and we want to hear your questions and comments. We'll be taking some time at the end of the session to respond back to the questions you post. Second, we are recording this session, and it will be available for replay in 24 hours on the YouTube channel, TBRI channel. Third, we will be sending a copy of the slides to the participants that selected to have follow-up communications. If you do not get a copy of the slides, or would like to speak with either Stuart or Allan after the session, you can reach out to them at the email addresses listed here on the first slide. Now, sit back, relax, and let Stuart and Allan tell you about the future of the public cloud market. Gentlemen?
Thank you, Allison. And thank you to all of the 180 attendees who registered for today's call, where we're going to discuss the public cloud and how vendors can prepare for the next wave of change. In today's presentation, we're going to present our findings and conclusions about the current state of the public cloud services market based on TBR Software Group's Public Cloud Market Landscape Report that was just released in 1Q11. We're also going to discuss 3 key waves of change that vendors and customers should be aware of that's going to drive greater levels of adoption for public cloud services and drive the market from $23 billion in 2010 to $80 billion in 2015. So cloud computing comes in 2 basic flavors, public cloud and private cloud services. The key differentiator between these 2 categories is that public cloud services, which we're going to be discussing today, is largely what we consider at its core a rental service. The end customers are paying for a service, which is a logical compute service that doesn't come attached directly to any of the underlying infrastructure. Private cloud, on the other hand, is purchased, constructed, and developed by the end customer to create their own forms of logical compute services. In this case, when we talk about that, we mean software as a service, platform as a service, and infrastructure as a service. Cloud computing is taking share away from traditional forms of IT consumption, such as build it yourself or outsourcing. In recent TBR research, we've looked at different workloads and the consumption patterns for recently deployed workloads among the IT population on a global basis. And what we've seen is a very strong shift from the build-it-your-own IT components and from the outsourcing model into cloud-delivered services. This is capturing the market as customers are beginning to understand that they have multiple avenues for deploying their workload. They have options, in other words. And one of the opportunities we're going to talk about, one of the key waves of change that vendors can capture, is helping CIOs understand what these options are, the impacts and trade-offs that they have, making choices for deploying workloads across this continuum. We're also going to touch on 3 key waves of change that vendors should be aware of as the maturing consumption of public cloud services drives greater levels of adoption and greater share and greater volume of business for the vendors. The first key wave of change are partner-driven business models. Today's public cloud services are largely sold directly, either through a web portal or through a direct sales force, and the partner-led model is going to augment, complement, and increase the adoption rate, particularly among small and mid-sized businesses. The second wave of change is shifting the economics of development. Today, development and testing functions are largely internal operations with an ad hoc collection based on individual programs or projects where development is driven by hiring or collecting assets, bringing the applications team, hiring contractors, and we see a shift through platform as a service to a much more structured but still loosely coupled environment. And we'll get into more details about that later in the presentation. finally, we see embedding capacity in the data center. Today, public cloud services are not integrated across the spectrum of IT sourcing. As we go into the future, we see consumers moving much more rapidly towards more hybrid environment and more hybrid architectures, which means a more complex sourcing environment. Vendors are going to have the opportunity to bring the value proposition for integration, for planning out the sourcing models and understanding, helping the customers understand the trade-offs between on-premise, off-premise, private cloud, mainframe, outsourced, in regards to specific workloads that support end-to-end business processes. The net result of these three waves of change is growth and increased consumption of public cloud services between today and 2015, where we see the market growing to over $80 billion. Many of the findings that we're going to present to you today are based on TBR's inaugural Public Cloud Market Landscape Report, which currently tracks 27 key public cloud vendors across 3 public cloud segments: SaaS, Platform as a Service, and Infrastructure as a Service. We've listed the companies that we've included in that study here for you. One of the key pieces to note is that we're using TBR's vendor-centric coverage to build a bottom-up understanding of the public cloud market space. Allan, the senior cloud analyst here at Technology Business Research, is going to give us a deeper dive into some of the conclusions and some of the insights driven by that report. One of the things to note is that where vendors work across these different segments of public cloud, TBR has worked to understand what part of their business drives into one area or another area. And we're welcome to have conversations with anybody who's interested, any of our clients on the phone or potential clients, about this report and give you some additional insight about its methodology and other findings that are within it. And with that, we're going to talk a little bit about TBR's overall cloud research matrix. When TBR looks at the marketplace, we want to understand key business trends and key technology trends through a business lens. So for our clients, when we take a look at cloud, we want to provide them with a view about market trends, customer perception and behavior. We want them to understand business models, quantitative financial insights around revenue and profitability, as well as vendor-specific or competitor-specific insights into what's happening in the marketplace. And for those people who want to read through the list, here's a short summary of some of the research studies and projects that we have underway right now. And now I'd like to turn the presentation over to Allan Krans, Senior Cloud Analyst in the software practice, who's going to present us some of the findings from the public market landscape.
Great. Thanks, Stuart, and I'm happy to be here to walk you through some of the findings from our inaugural Cloud Market Landscape Report and some of the broader research that we've done around cloud. So we wanted to start with a market perspective on where we see the overall market going over the next 2 years and how that maps to our research strategy. So really, as Stuart mentioned, we're building from the ground up, looking, and we'll walk through a lot of vendor-specific findings over the next couple minutes. But the other part that we do with our research is to combine that with a market view of what customers are buying, what's driving that behavior out in the market, and then looking into the future, how that's going to change and how those adoption patterns are going to shift. So to generate these overall market views, we've really combined those 2 spheres of research to come up with an overall trajectory for the public cloud market over the next 5 years. And I think the interesting thing to note is, so with our vendor-centric view through the cloud market landscape and through the syndicated reports, just how much of that market we're covering, over 30%, while still delivering that vendor-specific level of insight into what's actually driving the financials and the behavior out into the market. So with the next view, we want to provide an overview of the 27 vendors that we're tracking as part of the cloud market landscape. And the important thing to call out here is just how important growth is in the cloud market today. So whether you're a pure play vendor and this is your only business, or whether you're a diversified IT provider, growth is really the key element that's driving value in terms of the business models for these companies today. If we look across some of the different leaders, it really speaks to the diversity of competitors in the market, starting with OpSource, which is a small pure play vendor, not a company you would typically see lined up with an IBM or a Microsoft, but with the low barriers to entry in cloud, they're able to come in and quite quickly drive growth and presence in a market where in the traditional IT space, they simply wouldn't be able to get past all the barriers to entry around the legacy and the sales force and the marketing investments that drive success for those large established vendors in that space. It also speaks to some of the differences in strategy that we see where the traditional vendors are taking a hybrid approach. They need to really meld cloud into their broader business strategies. So it's a much more balanced approach, providing lower growth rates, but still a lot of opportunity in terms of the dollar growth for them to come in and complement their existing assets and drive presence in the cloud market. On the other side, we see the pure play vendors able to come in with a much more aggressive strategy. They're really all in. If they don't make it in cloud, this is really their only source of revenue and financial backing. So it's in their interest to drive as much growth as quickly as possible, and they don't have that legacy to consider in terms of the overall business strategy. So we're contrasting that first slide here with kind of a more dollar-centric view of the growth that's being generated out in the market. And across all of the vendor strategies, we see getting to scale as a really critical milestone and a focal point for competitors in the cloud space. And this slide really speaks to that. So you have Salesforce and Amazon who are leaders in terms of the dollar growth generated on a quarterly basis. Although they've been in the market for quite some time, and they're certainly not leading in terms of the percentage growth, they're still able to sense gaining scale, leverage that installed base, use it to generate high dollar growth that really sustains their business and builds on that annuity base in a way that is beneficial for their overall financials. It can be used in a lot of different ways. For Salesforce, we still see them really striving to grow the installed base, willing to sacrifice profitability in order to do that, and it's showing up in terms of their results out in the market where they're still able to continue to grow the annuity base and drive revenue growth after being an early leader in the market. And then also with Amazon, certainly growing the install base is important for them, but it also provides them an added benefit in that they have the capability to continually lower prices, which raises barriers to entry into the space and makes it more difficult for competitors in the market to establish a profitable and sustainable business model. So they're able to increase the competitive pressure due to their scale in the market. The other interesting finding here is some of the benefits that the traditional IT providers bring in terms of entering the cloud market. So we see Microsoft as a leader in this dollar growth chart. And this is somewhat surprising because they're a late entrant into the market. Certainly Salesforce and Amazon have been there for a lot longer. It took Microsoft longer to rationalize the portfolio, get their offerings in line, and really get momentum in terms of actual business traction in the cloud market. But their presence as one of the leaders in this chart speaks to the ability of just investment and presence on the traditional IT side to come in and quite quickly gain a large presence and business model in the cloud space that can put competitive pressure on some of the early leaders in the market. So I wanted to take a little step back here after we've gone over the public cloud market overall and start to get into some of the different segments that we're breaking out as part of the cloud market landscape report. So we're starting here with the SaaS segment, and when we look at this chart, we really see it as kind of a timeline for the maturity of business models in the market. So if we look down below the horizontal average line, you see some of the early leaders in the space with Salesforce and NetSuite. And they've reached a point in terms of their business models where they're maturing, the growth rates are slowing down. As we said before, it's more of a focus on sustaining that annuity base, and they're really not generating the high revenue growth rates that they had a couple years earlier. And then also, if you look at the current leaders, it's kind of looking at that second wave of growth with the traditional IT vendors coming in and using cloud to complement their existing applications and core technologies through a different delivery method and a different business model. So we see Oracle, Microsoft, IBM coming in, leading that second wave of growth that is really an outgrowth of a hybrid delivery model where they can map, whether it's traditional on-premise or cloud, they can really, provide options to customers that resonates out in the market in terms of that flexibility. And then extending on that theme with this slide, in terms of the leaders in terms of the actual dollar revenue contribution, Salesforce is still out in front, but all the other vendors that you see to the right of the vertical average line, they all have the ability to deliver hybrid solutions that either leverage traditional on-premise delivery, cloud delivery, or some melding of the two in between. So going forward, we really see a lot of value around that flexibility, and something that some of the pure play vendors like Salesforce, it's not a delivery mechanism that they can match, but we think it will be one that really fits a lot of customer needs out in the marketplace in terms of not being locked into either one, but having the ability to pick and choose which delivery method maps to their business or their specific use case. So now that we've covered some of the current state of the market with the financial performance of public cloud overall and SaaS, we want to start moving into the waves of change that we see coming up that are really going to evolve the market further from a $23 billion market today towards that $80 billion market in 2015. So the first wave of change we're going to review is the evolution of partner-driven business models. Now today, the distribution model for cloud has been exemplified by the two leaders in the space. If we look at Amazon and Salesforce, there's a lot of differences in their offerings and their business strategies, but really the one commonality we see is a direct approach in terms of delivering cloud solutions to customers. With Salesforce, it's an outgrowth of their aggressive direct sales tactics that look towards large enterprise customers to drive large overall deal sizes and get to that scale where they can have some flexibility with the business model. With Amazon, it's certainly a much different strategy, using their website as the primary sales interface. But when we look at both approaches, the commonality is that there's very little room or involvement for partners today in terms of how these offerings are sold, delivered, and serviced for customers. So in order to enable that next wave of expansion down to a broader customer base, to a broader set of use cases, we really see partners playing an increasingly important role in enabling that next wave of growth. We estimate that today somewhere around 5% of public cloud revenue is generated through indirect channels. And looking forward to 2015, we see that increasing to 25%. However, there's a significant number of barriers that exist in order to get there. Starting with the financial model, this is something that even the largest cloud providers today continue to grapple with. It's simply a much different revenue, sales compensation, and distribution model that is significantly different than the large, big deal, traditional IT sales that are taking place today. So as the vendors continue to grapple with this, that pressure and that uncertainty is shifting down to the partners in terms of rationalizing what the business models are around cloud and how they can build profitable businesses with this new delivery technique. So in order to get there, we see some vendors already starting to jump in and provide some of that guidance that's needed in order to guide partners towards profitable, sustainable business models around cloud that they can really integrate into their overall delivery of IT solutions. See Microsoft, IBM, Salesforce, all starting to promote programs around cloud delivery through partners. And certainly we see a lot more progress to be made in terms of clearly identifying the value add for partners in this market and demonstrating the financial viability of the models that can be built around those delivery models. So the next segment that we want to look at ties right into this evolution towards a partner-delivered business model, and it's the PaaS market. So all the vendors here see this as a critical point of stickiness in terms of the evolution of the cloud market. So they certainly want that partner investment in terms of applications and offerings to take place on top of their model. And we see a lot of variance in terms of the competitors that are in this space. So you have Microsoft as the early leader here, and their strategy is really to leverage their position of strength in terms of the traditional ISV platform and extend that into the cloud in a way that's seamless and provides that seamless access to traditional on-site delivery, cloud delivery. They're trying to really provide a very easy route for partners to evolve towards cloud delivery. But you also see new vendors, VMware, which obviously has a stake in terms of establishing a clear link between virtualization and cloud delivery, and encouraging partners to develop on its platform in order to cement that position. And then also Salesforce, which is led in with a lot of application sales, but is looking for that next level of stickiness that offsets some of the ease of switching and the risk of customer defection that comes with having a very low barriers to exit offering and establishing alternative routes of monetization for their position in the cloud market. So the importance of PaaS is not only through generating the revenue that is in front of you on the chart, but it's also all of the indirect routes to monetization that come along with having their platform as the basis for cloud partner investment, delivering solutions and applications to market, leveraging their platform as the baseline for that. So if we go on to, in terms of the dollar growth, again, Microsoft, this really speaks to their ability to come in after getting their solutions in line for quite some time, going through betas, and their early success in terms of transitioning their strength on the traditional side to the cloud and really establishing themselves as an early leader in terms of being the baseline for cloud development for ISVs delivering cloud solutions to market. So with that, I'll hand it back over to Stuart to take you through the second wave of change we see coming in the cloud market, shifting the economics of development.
Great. Thank you, Allan. As we talked about at the top of the presentation, today's development testing functions are largely internal operations. So as platforms as a service begin to mature and to develop adoption around them, we see a transition in the business space between the current model of development and testing, which is largely an ad hoc process around specific programs or product in the case of either internal development or that for an ISV. There is investments in packaged apps, in legacy applications, in creating new applications. There is the applications team itself, who are largely internal, with some augmentation by contract developers. There's internal data center assets that are leveraged, and we're beginning to see that really being the entry point for platforms as a service to be able to provide the applications and tools for development and testing and monitoring, as well as the infrastructure that's going to drive the build-out of new applications. However, the benefit of platform as a service is really the rise of ecosystems of developers. As we've seen in the open source community, the ability to disaggregate some of the code assets and some of the development methodologies actually increases the speed with which developers can bring new product or new applications to market. We also see the ability to create aggregates or even services for developers who are able to augment their own staff by parsing out those segments of their code development that may not add to competitive differentiation while they focus on those segments that are really the core attributes or the core features that are going to add the differentiation either for their internal clients or for commercial sale. We see Microsoft, IBM, and Salesforce.com all approaching this expanded vision of platform as a service in slightly different ways, but the net result is that the development community is beginning to see the opportunity here, and more than just using a marketplace or a web app selling place, but a real opportunity to build your ecosystem, build your applications revolving around the platform as a service. Even if you take that application and run it inside a private cloud or run it on distributed hardware or mainframe inside your own data center. So this shift is going to increase over time as development teams become more comfortable and as development methodologies and tools are built out. And this shift will drive greater adoption because a greater share of workloads will actually begin to be shifted to the cloud as they're developed in these cloud environments. So with that, we're going to start talking about the infrastructure as a service, which underlies all of these public cloud services. And on this chart, you can really see there's really two different groups. There's the ultra-high growth segments of the market, typified by GoGrid and OpSource, as well as just the regular high growth, so to speak, for cloud services. The big leaders here we see, certainly in terms of overall growth, are the pure play vendors, but also Amazon and AT&T, IBM, and Savvis, as well as Rackspace, are really driving adoption in this space due to customer demand for infrastructure as a service. Each one of these vendors has a slightly different take on the market. Amazon, with its serve yourself, do it yourself, build it yourself approach through its web portal. Rackspace emphasizing the support and its understanding of the needs of the IT manager or the development team management. And then AT&T and IBM coming in with more of an enterprise-focused play. When we look at the absolute dollar growth change as a new axis, we see a shift. The previous growth leaders shift closer to the axis, and we see Amazon and AT&T really bumping out here as the key leaders. Amazon, in this particular view, represents nearly 50% of the revenue that we're capturing here in the infrastructure as a service segment of our report. With that kind of market power, they really become the price maker as opposed to a price taker. We see this in all of our customer interviews and surveys where purchases are often made through the consideration of Amazon, and certainly the ease with which you can get pricing around certain configurations becomes a driving factor in any contract negotiations. TBR does not see this influence disappearing in the marketplace. Amazon is capitalizing it and using it as a market lever to actually drive more business into their increasingly direct sales force. Over time, Amazon is beginning to become much more sufficient and proved out as an enterprise vendor. We see them making very incremental steps in this area and succeeding despite some notable outages in the past year. Finally, I'd like to talk about the third wave of change. This one is taking infrastructure as a service as a lead and beginning to embed something that was available as an outsource decision, so to speak, where you could grab capacity on a utility basis out there in the cloud and push a workload out to it, and instead flipping that point of view around to embedding that into your own IT architecture. So simple infrastructure as a service offerings are going to be pulled in by the CIO and the IT managers as they make architectural decisions on how to address workloads, embedding them into hybrid architectures. So in our global research into buying behavior, we've noticed that CIOs are looking for reducing the cost of their IT workloads on a workload-by-workload basis. They want to reduce the complexity, and they want to reduce both their execution and their business risk over time. They want to improve their service levels, and most importantly, they're looking to become more business-oriented. They want to increase their alignment with the business or the lines of business that they're supporting, and also become known as one of the drivers for corporate growth. So the risk that they face is that adding public clouds to their IT architecture is currently a sourcing decision that's riddled with risk. We have a lot of conversations around security. We have conversations around compliance, around data management and ownership. The vendor opportunity here is to help CIOs and the IT decision makers make more business-driven decisions, to help the CIOs who are used to making IT decisions based on speeds and feeds of IT technology, to understand the business trade-offs that are involved in a sourcing decision, and to tie that back to the workload requirements for that business, for that line of business. So in a procure-to-pay situation, all of the workloads that are involved in that end-to-end business process, the CIO needs to understand the business trade-offs as well as the IT trade-offs in supporting those sourcing decisions for how they're going to support that business process and the workloads that are tied to it. So helping the CIO and the IT decision maker to understand that view of the world is a key first step. Building out tools and techniques and products that make that decision easier and to drive transparency both in IT operations and in financial overviews is a key differentiator. And we see several vendors actually beginning to make steps in the marketplace in the public cloud services for this. So to net this conversation out, we see a very healthy and robust public cloud market landscape that's undergoing extraordinary growth. The market size was $23 billion in 2010. We're currently looking at a 2012 number of approaching $43 billion. And with these three waves of change driving increased adoption for software as a service, platform as a service, and infrastructure as a service, we see the worldwide public cloud market increasing to over $80 billion by 2015. So public cloud services are coming to a reseller near you. The new economics of platform as a service will begin to erode the old methodology and value of a standalone in-house applications team. And embedding capacity in the data center is going to increase the adoption of hybrid architectures, which we believe will be the new normal from 2015 out to 2012. And with that, I'd like to thank everybody for their participation in this call, and we would like to take some questions. Allison?
Great. Thanks, Stuart. That was pretty informative. So we've got a couple questions that have come in. I'd like to suggest that if you have a question now, please send it to me during the Q&A portion or through chat. Our first question comes from Larry. Do all vendors define private cloud as a computing storage environment where the client is financially responsible for CapEx?
This is Stuart. I'd like to take that question because in our very first slide, we've taken a very broad cut on defining public cloud versus private cloud. So that's the majority of all cases, is that public cloud is going to be a service that you consume. Private clouds are going to be an asset and a way of delivering services that are built upon an asset base that you own. This is not to say that they're, as we talk about at the end of our presentation, hybrid environments. We already see the rise of publicly available services that you can consume on a utility basis that have a wrapper of privacy attached to it. So we have, Amazon was early experiments, or here with a, virtual private cloud. We see other vendors entering into this space, putting privacy, more control over the data while still having it sourced out of the building, out of the data center, not having to have the CapEx investment. That's one kind of early form of a more hybrid consumption strategy. We see that switching around the other way. So how can a vendor reach into your own data center and begin to abstract that and run that as a managed service for you? So that's the flip side of that privacy situation. The data, all the information, the processes are still running on my hardware, but the actual, the cloud and the cloud management of this thing might be shifted to another provider who has more expertise in this area. So we don't believe that it's going to be absolutely cut and dry, but for the purposes of looking at the public cloud business landscape, we had to make some decisions about kind of what was in and what was out.
Great. Our second question refers to slides 8 and 9 specifically. Did the study include TCS's IT as a service or Tata's infrastructure offer?
Sure. Thank you, Allison. This is Stuart again. Yeah, we had to. This is our inaugural report around the public cloud market landscape. We are beginning to, as I mentioned up front, add more vendors to the landscape. We're certainly happy to talk to vendors about adding them in as soon as possible. We want to make sure that we're covering all of the major vendors in this space. We understand their strategy, and we're looking forward to those conversations.
Excellent. We have a follow-up question on slide 18. There was a question on how does services orchestration fit in?
Sure. I think that fits across this entire presentation when we talk about the waves of change. We have opportunity for partner-driven business models. So service orchestration is going to be both a service that vendors and resellers are going to be able to do and go in and work with a business to understand those business processes and the workloads that are underneath them, and to begin to build out a plan, an investment plan, to efficiently source out and then orchestrate the different services that are going to drive the business, right? Have the IT connection to the line of business. That's a service opportunity. And then on the technology side, we see a lot of room for multiple areas of service orchestration, both in service definition, recombination of services, definition of architectures, monitoring of service levels, security, compliance, to go back to a time before cloud was possible, the building of composite applications, the management of ecosystem, visibility of opportunities. There's a lot of, that's a broad view of service orchestration. We can certainly look at it from a narrow point of view.
We have another question from Corinne. Where does CSD fit into the landscape? Also, where do other IPPs other than vPro fit into this landscape?
Sure. This is Stuart. I think Allan and I probably have some comments around this. As I mentioned earlier, we're in the process of building out the the public cloud market landscape, and we want to be able to add the significant market movers into this space, and we welcome that opportunity to have conversations with vendors that see themselves as significant players in this space. Allan, do you want to speak to CSC and maybe some of the other IPPs?
Sure. So with both CSC and Wipro, obviously they have a different approach to the market. So we see a lot of different backgrounds for the competitors that we've covered here. And I think that these IPPs are probably the next wave that we'll look at adding, because they certainly do, with their services background, have a real customer relationship that they can leverage in terms of delivering these services. And with CSC, we see them taking a very direct approach to delivering cloud compute, and then also getting into some of those hybrid private cloud as a service options, both delivered from their data centers and going to the customer site to kind of cordon off a private cloud on-site to deliver some of the attributes of cloud computing. So we do see a fair amount of participation from the IPPs, a lot of different ways that they can generate business models and revenue in this space. So I think there'll be a focal point as we evolve the report moving forward.
Great. We have a couple more questions. We only have a couple more minutes left. We have a question that came in from Paul. Are your numbers for infrastructure as a service growth, including both compute and storage services combined, even though in the case of AT&T and Amazon, these are separate service offerings? The second part is, or does this growth only cover Synaptic and S3, for example?
Yes, this is Stuart. I think we're looking at a high-level presentation of infrastructure as a service that combines both the compute and the storage elements of infrastructure as a service. Obviously, when we get underneath the covers and we look at what the key drivers are for revenue growth, the growth is coming from one portion, say, Synaptic or some of the other areas.
Great, and our final question comes in from D. Shetty. Discounting the various benefits and risks associated with private and public cloud purely on a financial cost basis, what is the TCO differential between private cloud versus a public cloud infrastructure only for an enterprise?
I think that's a wonderful question. Thank you for asking it. Even though that wasn't really the focus of the presentation today, I think this is something that we would like to have a broader discussion with you on. Just to touch on this, when you talk about total cost of ownership, particularly just for infrastructure, when we look at public or private clouds, there's a lot of different dimensions that go into that total cost of ownership. So what aspects, what's the volume of the business, what is the duration of the business, how deterministic are the workloads that you might consider shifting to a public cloud or leveraging in a private cloud, as opposed to the variability of the data loads or the computing loads. These are all elements that go into a TCO, as well as several others around the alignment of the business, the global distribution, the nature of the data transfer, the compute intensity of the workload that we're looking at. So when we take and do some of the TCO analysis, we really want to get down to the workload, answer some of these questions, because as I mentioned earlier, when we talk about embedding public cloud computing into the data center as a hybrid architecture, along with other sourcing options, these are the exact types of metrics and measures that have to get determined in order for the CIO to make those trade-off decisions. So I think what the question you're asking is the starting point for understanding the sourcing discussion, and that's where many CIOs are at right now. Well, what's my TCO? We're suggesting that conversation needs to get advanced so that you understand not just the investment aspect of the payment or TCO, but also the business risk, the operational requirements. How is that investment tied to returns on the business side? There might be a very strong case for making deep investments for a particular workload where you have proprietary or competitive advantage in the market space. So good question.
And we have one final question from Larry. Do you foresee infrastructure as a service becoming a commodity service? Can the market support the current number of vendors, or should we expect fewer vendors either through consolidation, or will vendors change their cloud offerings, i.e. SaaS, but not infrastructure as a service?
This is Allan. I'll jump in and take that one. So when we look at the commodity status of infrastructure as a service, we certainly do see some elements of that out in the market, and I think Amazon really exemplifies that, focusing purely on a lot on price, continually reducing that price, increasing the pressure in the market. But the response that we've seen from a number of the vendors, and we think this is well aligned with how customers view the value of these offerings, is to avoid that pure price competition, focus on all the different value that can be added around the services in terms of broader business solutions, certain elements of security and access that can be wrapped around them, SLA guarantees. Certainly when we look at a company like IBM, they're going to have multiple tiers of infrastructure as a service. The top tier will really be differentiated in that it has that SLA guarantee, it has enhanced security. It's not solely a price competition, although they will be competitive on price. There will be those value-add differentiators that gets beyond a commodity offering, and we think really aligns better with how customers view these services. So part of it is cost in terms of the benefits that's delivered, but more broadly, it's around the flexibility and the ability to align IT capacity to their business requirements in a way that is possible through cloud, and that's significantly more difficult or harder to achieve through traditional IT sourcing.
And to address the second half of that question around the potential for consolidation in the marketplace, yes, we think that there is a strong potential for consolidation in the marketplace. Even though the overall market continues to expand and vendors have opportunity for very strong growth rates and adoption rates just by developing their own offering. We see vendors, making acquisitions. Terramark was acquired to add that capability onto Verizon. Other vendors are well positioned for acquisition, and the key there is if you acquire a business that has a very strong growth rate in and of itself, what's the integration strategy for that business? How do you allow them to continue that strong geometric growth rate without inhibitions while still providing that roadmap for your own cloud strategy as you go forward?
Great. Thanks, Allan and Stuart, and thanks for everyone for dialing in today. I will be sending out the slides to everyone who registered, and we encourage anyone with any follow-up questions or comments to email directly to either Stuart or Allan. Their emails are on the last slide. And look forward to having our next webcast in the series on IT appliance adoption. Thanks, everyone.